Hello again, and thanks for checking out the fastest 4 minutes in finance. I'm financial advisor Scott Inman. Well, it's easy to resist talking about inflation and interest rates on the fastest 4 because it feels like we talk about them a lot. We do. But when there's economic news on both in the same week, it's inevitable. And when they are the biggest concerns for the economy, it's important. The inflation rate surprised to the downside for the second straight month. The Consumer Price Index for November rose 7.1% year over year. That's the smallest 12-month measurement since December of 2021. Month over month, prices were only up 0.1%. Looking deeper at the numbers, energy continued to drive inflation down, dropping 1.6% when compared to October, but food prices were still up 0.5%. And taking a look at a couple of charts provided by the Bureau of Labor Statistics, we can begin to confidently see that inflation looks like it has passed its peak. The first chart shows the month-to-month increases since November 2021. The peak was June, when it rose 1.3%. Since then, you can see no month has even been half of that. Now keep in mind, to reach the upper end of the Federal Reserve's preferred target of inflation, 3%, we would need to average 0.25% per month. The monthly average over the past 5 months is less than that. On the second chart, the blue line represents year-over-year CPI over the past 12 months, and the red line represents core CPI. That takes out food and energy. You can see CPI has been trending down for the past 5 months as well, with volatile food and energy prices lagging by a couple of months. Of course, there's no guarantee here, but there is good reason to believe inflation is moderating to historical averages. But what we think doesn't really matter near as much as what the Federal Reserve thinks. For the markets to have confidence in a better economy ahead, both inflation and interest rates need to moderate. The Federal Reserve once again hiked rates this week, with the Fed funds borrowing rate now around 4.5%. The markets are looking for a signal that the rate hikes will stop in 2023. Historically, markets do well at the end of a tightening cycle. So when will that happen? LPL chief economist Jeffrey Roach points to spring of 2023 as a possibility. Using history as our guide, the Fed doesn't typically call off the rate hikes until the rate equals inflation. We are getting closer, but we're not there yet. If inflation cools over the next few months, we will get closer. So what's all this mean for our investments next year? Well, there is nearly universal thought now that the U.S. will enter recession early next year, but Jeffrey Roach points out 2 things that we should remember. First, the average recession only lasts 10 months. And second, oftentimes the market does well during the recession because the risks have already been priced in before they occur. That should give us confidence that 2023 will be a better year for stocks and bonds. Thanks for listening. Want more content like this delivered to your inbox weekly? Visit fastest4.com to learn more.